Welcome to the Centennial Edge. I'm Justin White, managing partner of Centennial Advisers, and today I'm joined by Jason Brooks, and we're going to discuss Opportunity Zones, Opportunity Zone 2.0, and how investors and companies having IPOs can use Opportunity Zones as an investment to reduce taxes, provide cash flow in retirement, and have the opportunity to buy very secure investment opportunities. Today, Jason and I will discuss not only the ins and outs of opportunity zones, but how, if you're fortunate enough to be a part of one of these initial public offerings, how you can use opportunity zones in addition to a number of other investment alternatives to reduce your capital gain exposure from the event. Jason, thanks for joining me today. Any early comments that you'd like to start with as we go through this?
No, I think that there's a lot of forecasted IPOs this year of major size and scale from, SpaceX to Anthropic to OpenAI, Stripe, and others. And this is a great opportunity to discuss that. And I think, to the benefit of all those listening, if you're in a lockup period that takes you past, the end of this calendar year when you can actually sell and realize your gain, then next year you'll be able to be eligible for Opportunity Zone 2.0. But anybody that's able to sell this year will be eligible for Opportunity Zone 1.0.
And in reality, there's a number of things we've learned from the last 9 years of Opportunity Zone 1.0. Jason and his expertise in opportunity zones and in opportunity zone structures, along with our commercial real estate expertise, has saved a number of clients over $100 million from capital gain events from the sale of their companies. Um, Up to this point, most of our transactions and help with these clients has been founders and perhaps early employees in some of these companies. But with, as Jason mentioned, the number of IPOs forecasted for the next 12 months and some of the size of them, there's a lot of people that are going to benefit and have quite large capital gain events. Jason, you want to talk a little bit about opportunity zones, what they are, and how we've helped people use them up to this point?
Sure. So opportunity zones were originally passed under President Trump's first term, and they, I believe, were the only consensus bill passed during his first term. And what it did was it created over 800 census tracts around the country to drive investment into those tracts. So if you invested capital gains money, either by buying a piece of real estate and then developing something from the ground up, or buying and investing in a rehab project where you were significantly improving the property, you could get tax deferment on your capital gains tax as well as tax-free appreciation on the real estate. This also created opportunities to found and start businesses in the opportunity zones that you could also exit in the future tax-free. The minimum hold period for the full tax-free benefit was 10 years, but it could have been up to 30 years.
So let's take it a little deeper for somebody who might be a part of one of these IPOs. They've accumulated stock over the years, and the company has their public event. Walk them through if they are interested in getting a close to absolutely passive investment with a high credit tenant that provides them long-term cash flow, the mechanics and how they would use a captive opportunity zone fund to acquire some of that real estate.
Sure. So there's, two different ways to do an opportunity zone fund. The first is you invest with a third party. The downside to that is if you don't have enough capital to buy your own property, you can go into one of those deals, but there are often high fees that reduce your return, and you have less flexibility because you're at the mercy of the fund operator on when the property is sold. In a captive fund, you set up your own fund and you acquire your own properties that you control and own 100%. And so there are a few benefits. If you're going to be in Opportunity Zone 2.0, there is some deferral on time of your tax payment. But the best part is tax-free appreciation. So you will get a passive, well, can't be fully passive, but a mostly passive property with a credit tenant operating in there, and you're just the landlord. We call it we used to call it mailbox money. I think now it's going to be called auto deposit money because there are no physical checks sent anymore in this day and age from most of the tenants. But you're getting a high credit tenant paying you, somewhere usually between 5 and 6% return on your equity capital annually. It is very low risk. It is very low maintenance, very low operations, any requirements on your part. And, Centennial also has a property management company that they work with that for a minimal fee will take care of those very, very small requirements. And you can find in different parts of the country the kind of tenant you're looking for, the kind of property you're looking for. We can even do certain things to benefit you, like finding a place where you travel often to visit family, or if you have a second home, because there are other tax benefits associated with doing that as well.
So, Jason, there's a good chance that the investors that we're talking to, or people that would be interested in this, have spent their career and have a huge amount of their net worth and effort into the company that is having the offering. So they're not too familiar with real estate, and they're less familiar with how and timing wise an opportunity zone works. Can you walk somebody through from, let's say, day one, the IPO, timing, when things need to happen, how long they have to set up the fund the fund, and then acquire property through their fund?
Sure, absolutely. So, first, your company IPOs, congratulations. It's a really exciting day. But unfortunately, you're usually not allowed to sell your stock on the first day. There are restrictions. Maybe you get to sell a small amount of it, but often for early investors, for employees of the company, for large insiders, there are what they call lockup period. And that lockup period can restrict your shares from being sold anywhere between 30 and north of 180 days. And the reason being is the markets have supply and demand. There's going to be a lot of demand on day one, but they also don't want to flood the market on day one, because if they flood the market with too much inventory, it will cause the price to go down. Because the way the stock market works is you put out shares for sale, and then I'll sell at X price or I'll buy at Y price. And, if there's too much inventory and not enough demand, the price will drive down. So you may be stuck in a lockup period. Well, once your lockup period ends, I think is where we should focus, the discussion. And then you have a choice of when to actually sell after that period. And so when you sell, because it's a stock sale, you will have 180 days from that sale to set up your fund and invest your money into the fund. Then from there, you have 180 days to acquire the property. Now, what I tell people is, if you know that this is a strategy you want to do, don't wait the 180 days to set up your fund, and don't wait 180 days to buy your property, because the sooner you set up your fund and the sooner you identify and acquire your property or properties, the sooner you start getting that passive cash flow rent from your tenants. And so there's no real incentive to wait. You should just put the money in, quickly, get it set up and start buying property. So you start your cash flow.
So great job in explaining kind of the timeline and how long somebody has, and the mechanics of setting up the fund, and how it all needs to happen. Um, Maybe talk a little bit now about opportunity zones. You've certainly talked about the benefits, the deferral, the step up in basis, the depreciation recapture benefits. You kind of mentioned all of those, and the ability to buy credit-worthy tenants on a very passive lease structure. Are there any restrictions or things that an investor has to consider when buying in an opportunity zone?
So I think the main thing that people need to understand is, in order to maximize the benefit, which we would tell you is the right way to do it, you need to hold the property for at least 10 years before you sell it. Additionally, if you were to choose to buy a property in cash and not use any financing at the time of acquisition, you would need to hold the property for at least 2 years before you could refinance the property and pull cash out. Now, you're allowed to buy the property with a combination of cash and debt, but the most important thing is, if you are going to buy it all cash and you ultimately want to refinance, you need to wait 2 years before you do that. The last thing is the improvements of the property and how the property you buy. So you can either buy a property with an existing structure, and then you need to improve the existing structure or build ground up equal to the value of the existing structure at the time of acquisition. Now, another option, which we recommend for most of our clients that are not in the real estate business, is if you close on a purchase of a property before it receives its certificate of occupancy, you get credit in the IRS rules and opportunity zone rules as if you had built the property from ground up. So you will meet all of the requirements of the additional investment. So I would say, Justin, of the I mean, we've maybe done one or two deals that were um, not complete, pre-C of O deals, those kind of things. I know we have one right now, but the only reason we're doing it is because the client owns the neighboring property and the properties touch, and he needs to do more work on both of the properties. And so that's why it makes sense. But I would say almost every one of our clients has bought a pre-certificate of occupancy new construction property.
So talk about that for a second, because if somebody is interested in this and they're going to go try to find some opportunity zone properties, be real clear, because they can't just, every property that is currently built in an opportunity zone isn't going to qualify. It's not going to qualify because of the improvements, and it might not qualify because of the lease structure.
Well,
Um,
and also,
Talk about that.
Justin, most properties that are on the market are already completed. So therefore, the certificate of occupancy has been issued. So you need an advisor who specializes in sourcing those transactions prior to the completion of their construction. If you're working with a normal broker, they're gonna either not know all the rules correctly potentially, or they're gonna say, oh, here, this is an opportunity zone, this is an opportunity zone. But the problem is the building's already completed, and oftentimes these products aren't sold until the tenant's paying rent. Well, once that has occurred, it actually doesn't qualify for the opportunity zone. So I think that's one of the biggest keys and takeaways is, that part of it. The second part of it is you cannot have a pure triple net lease. The point of the law was to create jobs, not just in the investment and the development, but in the ongoing operations of the property. So you can have a, double net lease where tenant or landlord has a small amounts of responsibility, and you can have other forms of lease as well, but those require a lot more work by the owner. And so we, try to guide clients to these, modified double net leases that we think are best for them.
Talk a little bit about that, because you and I both said passive, or really close to passive. Um, in all the transactions that you've helped clients facilitate, um, what has been your, like, describe what management the clients are doing as the owner to satisfy the opportunity zone requirement, and then maybe tell us your favorite thing that an owner does to satisfy that requirement.
Well, I think you and I have different favorite ones, but so we oftentimes these leases are pure triple net, so we need to modify the leases to make sure that they qualify for the property. I've never met a tenant that would decline you taking on more responsibility as the landlord that was normally their responsibility. Now it's about taking on the right responsibility. Often, one of the main things we look at, for example, is like roof repair and replacement as a landlord responsibility. The reason being is that in these properties, traditionally, when you're buying new construction, the roof is brand new. It comes with a 20+ year warranty, oftentimes. So you won't have to replace it during your hold period as the owner. And then, the company that installed the roof for a small fee will do an annual inspection, make sure that there's nothing that needs to be repaired. The repair is also covered under the warranty. So while you have management responsibilities, you don't have increased costs. I know another one, Justin, that one happens to be my favorite. The one that you often talk about is landscaping, which I also think is, another good one. It depends on the market. I mean, I'm a big fan of landscaping in Arizona, mostly because with desert landscaping, the plants take care of themselves and the rocks don't really need to be raked around. But there's certain landscaping maintenance requirements. They're very minimal. And if you have a small property manager or a property management manager that's helping you with some of these things, like one that Centennial can recommend, they can hire as needed a landscaping crew to go out and take care of those items.
Awesome. Let's talk before we get into some of the other questions that people may have regarding opportunity zones. Um, Walk me through uh, describe some of your favorite transactions, like the client that we helped, uh, their situation coming into it, whether it was, one of your favorites is because it was at the absolute last minute and we saved them a couple bucks, or properties that we got somebody into that were some of your favorites. Like, let's go through a couple of your favorite stories, kind of just one by one, um, of some of these transactions we've done. Because, like I said, when we opened this thing, we've done a lot of owners of companies, but
Right.
everybody who's going to be having a event through one of these IPOs is an owner of the company.
Right.
So while it may have been an individual owner at a time and not a division manager at Anthropic or something like that, they are very, very similar roles. Tell us a little bit about some of your favorite people that we've helped.
Well, so I guess we'll talk with the fastest deal we've ever done, which was one of the first deals we did probably 5 or 6 years ago together in this space. We helped a really great guy who we're actually about to help with some more stuff here coming up. He had just sold his engineering business and we needed to close it. We were looking for a second deal. We had bought him his first deal. We needed a second deal before the end of the year. And I think it was something like December 12th. And you found a brand new construction Burger King. I want to say it's in Indiana, but it is right outside the entrance to a college that has 12,000 students. And it's owned by a franchisee that has over 1,000 units and over $100 million a year in EBITDA. They're publicly traded franchisee, actually. And we were able to go from LOI to close transaction before Christmas. And I think you found the property on the 12th of December. So that is one where we took up, he owns a civil and structural engineering business, so he knew real estate. And I think if you talk to him now, his favorite thing is to tell people about how amazing his life is because he has passive cash flow that shows up in his account every single month. And how exciting it is. And he even joked, I talked to him last week. He was driving back across the country from his daughter's grad school graduation, and they were driving back with all of her stuff. And he goes, "Oh wait, it was Monday. Today's the first of the month. Let me check my account. Oh wait, all the rents are here. This is great." Like, he was just excited about that. So I think that was one I really loved. We actually helped Justin two clients last year who were founders, but they sold their business in a very large public transaction to a publicly traded company. So that's a much larger stock sale, a lot more shareholders in that transaction. And we bought them a whole mix of different assets. They both ended up, I think, with a Starbucks. There was a Chipotle. There was a Rivian charging station. There was a deal in Sparks, Nevada, in the largest industrial park in the country. And then, as usual, what seems to pop up when we have larger amounts of money to put to work, a handful of new construction 7-Eleven, gas stations, C-stores. And we can maybe talk a little bit about the value of those and why we've seemingly done a lot of those over the years. But that's another one where it was a totally different situation, not a small privately held business. And then I guess I would say the third client I like to talk about is probably our favorite people to work with in this space because we've now bought them 8 or 10 properties over the course of multiple business sales. And they're actually selling another building today in Alabama. And so I have a feeling we're going to be doing this more, but we've even used this as an opportunity for them to buy not just passive cash flowing assets, but what's really interesting is one of the businesses that they haven't sold is actually located in an opportunity zone, and the neighboring parcels to their property there are have come available for sale. We're actually going to buy those in their opportunity fund, build them a new corporate headquarters there with new buildings and so now they're actually able to benefit it not just through their passive cash flow, but with their actual current and ongoing operating business. And we're actually going to work on setting them up an QOZ business that will be there so that when they end up selling that business, probably 10 plus years from now, they'll be able to get that benefit too on their business side.
Uh, what are some of the favorite locations
Oh boy.
for you that we've done these deals?
Um, man, I love the South Carolina property. Uh, that that's one of my favorite. I was at Mount Pleasant or Bluffton, one of those places. I think we've done ones in both. I do love the Sparks Industrial Park in just outside Reno. I think anything in that industrial park is an amazing deal and an amazing purchase. Um, I don't know. I mean, we've done some really good ones in Florida, some good ones in Texas. I think the reason that they're good, Justin, honestly, is the location of the real estate and the long-term value. I see them as places that necessarily shouldn't have been opportunity zones. And I think that's the key, right? Like we've even done ones where you're like, well, that doesn't make the most sense. Like that's not, is that the greatest location or not? I mean, we've done some in Phoenix though that are like in the brand new construction, consider them the Irvine of the newly built areas in the greater Phoenix area. And I think for me, there's those opportunity zones that you guys have found that shouldn't necessarily be opportunity zones where the real value is long term, because again, location's still the thing that matters most in the real estate, and that's where I think the value's the best. So,
I think that's really like that's been the fun part for us. I mean, these tenants, whether it's 7-Eleven or Chipotle, Starbucks, Caliber Collision, Dutch Brothers, Canes, like you name these brands that people are super familiar with, that are good, strong, secure companies that appeal to younger demographics. Like those things are kind of easy to find. The fun part has been finding what we call the golden OZ uh, census tracts. And the interesting part about OZ 1.0 is now we're 16 years from when the census tract, the data that drives the census tracts was determined. So
right.
you were talking about Mesa, Arizona, and I think we've done two in Mesa now. And in 2010, Mesa was alfalfa fields, maybe. And now it is a great suburban, good restaurants, good grocery stores, good child care, like all the really nice things. And we're going to be doing the same as OZ 2.0 rolls out. Like the neat part about right now is that you can still use the 1.0 data and acquire things in 2026 and get some of these areas that shouldn't be OZs anymore as part of your portfolio. But just like we were doing 10 years ago when we started this, for OZ 2.0, there's going to be the college towns. There's going to be the micro MSAs that are designated as rural now, but because of energy, because of infrastructure, because of um, you know a industry being wanting to be synergistic and kind of coming into an area and building out an area. In 2.0, there's going to be areas, OZs that by the end of it, most people would agree probably shouldn't have been one. I still think we missed out on the car wash north of Detroit as one of the unique OZs that shouldn't have been one where our client was going to, really get a benefit of being in an awesome area and getting all the OZ benefits. But as we move into 2.0, there will be some, and I will tell you, I'm super excited about the rural benefit. And so as part of OZ 2.0, there's a 5-year rolling deferral, um, or excuse me, a 5-year 10% reduction of your capital gains tax when you hold a property for 5 years. In 2.0, if you buy in a rural designated OZ, there will be a 30% reduction of the capital gains tax owed in 5 years by buying a rural property.
But I
There's going to
have
be a lot of rural census tracts that 5 or 10 years from now shouldn't be ones, and they're going to be the fun ones to find and help our clients get into. And yes, I'm struggling with saying rural.
I have to imagine though That, and I can't believe I forgot these three because they happen to be in the state that I live in. But the Starbucks that we bought across the street from the Buc-ee's that is on the highway between Knoxville, Tennessee and Nashville, like it is, you get off the exit, you go to Buc-ee's, you go to get right back onto the freeway, and you have to make a left-hand turn right in front of the Starbucks. And I'm going to guess that that's probably considered rural. The 10 years ago, Murfreesboro, Tennessee was probably considered much more rural because outside of MTSU, there wasn't a lot there. And now it looks like, Irvine 10 years ago, and it's still growing. It's the fastest growing suburb of Nashville. And we did a 7-Eleven gas station car wash there that's in a, in a shopping center anchored by the biggest hospital systems medical office building and a brand new Publix grocery store. And then I think the other one I think of is the 7-Eleven gas station that's not far from that Starbucks out that way too, which is probably considered rural. And yet it's in a huge shopping center in a really fast growing area. I think those are a lot of opportunities. And for a 30% reduction in your bill, Justin, that's a lot of money. So, um,
Yeah, if you mentioned earlier, uh, you we can make through using the depreciation, finding a 7-Eleven, the right tenant and the right structure, we can help people um, avoid a lot of the tax by completing a OZ transaction in the same year as they have the gain. Um, yeah, when you layer some of all those things together, it can be really good. And there's going to be a lot of significant capital gain events for people that are a part of these IPOs that want to now have the ability to diversify. Um, talk for a second. Like, in your opinion, is it hard for somebody who has never invested in a lot of commercial real estate to invest in an OZ?
that's a great question. And on that topic, I saw an article today that there will be over 300 welders at SpaceX that will be multimillionaires from the IPO. Which is a really cool fact and statistic, right? You have computer programmers, you have people that have never touched real estate other than maybe buying a house. And so when we talk about the type of real estate you're going to be buying, I think you'll have no problem, no matter your background, your level of real estate sophistication, what your education is in specifically managing your own fund. I would say most of our clients that we have done this for spend less than 10 hours a year managing anything related to their property. And it's often less than that. It is, you hire us as experts, both, myself and my legal team, your advisor at Centennial, to guide you through the transaction. It's our job to make sure that your purchase agreement is fair and you're protected. It's our job to make sure that your title is correct, your survey of your land is correct. It's to make sure that the lease is in force and effect and there's no loopholes or trapdoors out of the lease, and that you're, buying this cash flow from this, credit tenant. That's our job to protect you. Once the property, and it's obviously Centennial's job to find you that property, but once that property is purchased, and we're happy to answer a million questions. If you have them, we're happy to walk you through. But we have some clients that just say, let us know when it's time to sign, and can you get me the wire instructions so I can wire my money in to buy the deal. But once that's closed, there's a little bit of setup where, we got to make sure, and that's part of our job, but the tenant knows where to pay the rent. But after that, it's very minimal work, very minimal requirements, and we're happy to, both us and Centennial, to make ourselves available to answer questions. But I would say that most of our clients spend less than 10 hours a year on a property. And often, like I said, many far less than that, many probably 2 to 3. So
If they want, they don't have to spend a lot of time. And I think, what's unique about the deal size and the things that we find, and we're finding anything from $1 million to $25 million so far to satisfy people's OZ desire, is that almost all the time our clients can have as much control as they want. Do they want to own it just themselves and have total control and decide to keep it for the 10 years or to sell and trade into other OZ properties at various points in the 10 years, they can have that total control. We also have some where people that have had success together at a company want to continue to invest together. And so they might buy a larger portfolio where it's 2 to 5 or 10 people pooling their resources. Um, but regardless of the number of people that they have in their pool, whether it's them or a couple of friends, the nice part and the comfort is that they're the owner and they're in control of the decision making when they do something, when they don't. You'd mentioned the ability to refi 2 years down the road to do that, or to keep to keep the financing structure the way it is, or to sell and trade into a new opportunity. Um, they have the total control of as much effort and as much um, involvement as they want in their investment, as opposed to a lot of these funds that offer a return that might be comparable, but they offer no control. And part of that no control is probably you don't need to go see the real estate. We'll look at it. We'll do that. Jason, talk a little bit about your position on, while these things can be very passive over the ownership, um, how important I would say we feel it is that they go look at the real estate, that we're analyzing the real estate and making sure that, yes, we're buying the tenant and there's a ton of great tax benefits, that we're still buying a good piece of real estate that's going to hold its value at least the 10 years.
No, I think we've never done a deal together where you guys have not gone and seen the real estate before the contingencies were up. I think it's important, not just because, and we've talked about some of these locations, right? Like if I told you that you were buying a Starbucks in Crossville, Tennessee, your answer is going to be, well, where is Crossville, Tennessee? And why do I care about where Crossville, Tennessee is? And maybe you don't care that much about where Crossville, Tennessee is, but you do care, like I said, that it's on the corner across the street from Buc-ee's on one of the busiest highways in the country that leads to the most visited national park in the United States. That is something that just looking at a piece of paper and maybe a write-up doesn't necessarily tell you. But then you can also, while you're out there, drive around for an hour or two and see where all the housing is being built, see where the development, see if, out there at least, like University of Tennessee Medical System is building a medical office building, or what other things are going on in the area. And so sometimes you might look at a map and say, well, this piece of real estate, why is it good, or it doesn't make sense. But, if you're putting a gas station, C-store structure, and it's at the crossroads of two of the largest highways in the area, and 15 or 18,000 cars pass through it on a weekly basis or daily basis, or those numbers, and you see how busy. I mean, I know you love to talk about visiting some of these stores when we're buying restaurants, and how busy are they at lunchtime? How busy are they at dinner, right? Or if you're even visiting a gas station, looking at the shops around it that are selling food and seeing how busy they are, how busy are the parking lots. You can't do that without visiting them. So I think I would recommend everybody go see it at least once. But what that does is it tells you that it's a good piece of real estate. And I think that's the key, right? I remember, I think the deal that we should have bought that we didn't was that TD Bank in Florida. That was essentially, you remember exactly which one I'm talking about.
Yeah.
It was in an area where the average household income was well north of $100,000. It was brand new construction, TD Bank. But the way they built the bank was that if the bank ever went out of business, or not even went out of business, but got rid of that location, you could quickly repurpose the building to a fast food restaurant. Double drive through. It had like space design that would fit as the kitchen. They pre-pulled utilities. Great investment, right? But you're thinking, oh, do I want a TD Bank? People don't go to the banks as much. Are banks dying? Like, I almost think that long term, your hope is that the bank stops being the tenant there, and you get a chance to bring in a really good fast food restaurant, which is going to be a better long term play. So, and I know you remember exactly which one I'm talking about.
I love that one. And that's kind of the fun part of when we look at a lot of them. Like, our clients have bought a lot of really good ones. There's been some good ones that slipped through the cracks. And there's been a lot that just haven't been right, because of the location, because of the lease, because of it was facing the wrong way on the lot, or any of those things. Um, but hey, for a second though, you brought something up, and I think it's an important one for somebody who hasn't been, in the space, is not a real estate investor, but is benefiting from their company going public. Is like, I'd be worried a little bit that I was going to buy this thing, and I had one tenant that was paying me a lot of rent. Um, Talk a little bit how we try to go about preserving capital, what we try to focus on for these people, and the investors that, I mean, they've made the money. Our primary objective is they don't have to make it again. They maintain it and get bunch of great benefits. But how do we reduce the risk of tenant going dark?
Sure. Well, just in, I would say, I would point out, Justin, like you're buying the credit of a company. So let's just talk about Starbucks, for example. You're buying Starbucks as your guarantor on your lease, right? And so in theory, even if they decide to go dark at your property, and what we say by going dark is they open for business, they're operating, they decide that it's not making the profit that they want and they want to stop operating daily business at the property. That doesn't mean that the rent's not owed. And we have seen, not necessarily in situations with our clients, but in situations where, you guys are helping someone sell a different net lease property that's not in an OZ where the tenant went dark, the tenant's still paying the rent. And then, what we've tried to do is negotiate a lease buyout with them, and especially when we have a new tenant in hand, so that we're actually trying to turn this into a way to make extra capital. But just because the tenant goes dark doesn't mean that they're going to go, stop paying rent. The other thing is, most of these big corporate credit tenants that we're buying have a team of people. So think of, there's a team of welders at SpaceX. Well, these people have a team, 35 to 50 to 100 people in-house whose jobs are just to identify the next locations. So they've been doing this every day for 20 plus years. They know their metrics. They know what they're looking for. It reminds me of, there was a Starbucks that we looked at for a client in Missouri, and there was three things in it. There was a restaurant in the shopping center, a Walmart, and a Starbucks. And it was kind of in the middle of nowhere. And so it was trading at a higher rate of return, but still a Starbucks lease guaranteed by Starbucks. But when most people, if you, again, to the point of driving the real estate and doing the research, it was the Walmart that serviced a college town 25 minutes to the south, and the next major town around, which was 30 minutes to the north. So Walmart decided that they were going to invest into an area and build something that was around, technically not a lot, and for 20 minutes in each direction, but 30 minutes in each direction. There was a major city on one side and a major college campus on the other side, and that's where they decided to put it. I would tell you that I would be happy to own that Starbucks. A, because I was getting about another 1% return on my money, but B, because in order for that property to end up not working out, Walmart has to be wrong, Starbucks has to be wrong, their teams have to be completely wrong, and they're still going to be paying rent. But again, at the end of the day, I think, they've put in a lot of work and research, and that also helps drive our decision.
Um, Jason, for some of these people that are having these events and being a part of these companies, um, they might wonder, well, do I use my first window to diversify a little bit and sell some of this stuff? Or, in your professional opinion, should they wait and see what comes out in 2.0 before they decide to do anything?
So I think I would look at it as, if we found a great property in 1.0, because remember, you talked about when the census tracts were from 2010. And we now know 16 years later what's good, and like what are those golden OZs that might disappear. So I would say, let's see if we can find some really good properties this year that are just phenomenal pieces of real estate that are not going to be part of the OZs in 2.0. So I think that there's an opportunity to take, let's call it 16 years of data, or at least the last 9.5 years of OZ, what we've learned and what areas are the best, and see if we can identify some great properties there. And then I would say, you can also then, if you're going to look for the larger amount of the deferral, the rural 30% or another 10% not for rural, we can sell the stock in January. My one point would be, doing it in January, if you have the right to sell your stock and you're going to wait for 2.0, I would do it in January, as long as the stock price is still trading at a number you're comfortable at, because the sooner you do it, the sooner you get your fund set up, the sooner you start your cash flow. As I said, we've done plenty of deals where we've gone from thinking about needing to do the deal to closing the deal in under 15 days at the end of the year. And it's always a scramble, but we always get it done. But I would say, why not? If you can do it early and you can control your destiny, do it sooner. So,
Jason, I'm fortunate to know that you got a deep roster and list of clients that call on you for not only their real estate advice, but a lot of their financial and wealth management. They want your opinion. You've certainly had a lot of people over the course of your career um, be a part of a, an IPO event. Why do you recommend OZs as an option for people that are having those events?
so I think you made the point earlier, which is the key. The great part about buying net lease real estate, especially in an OZ, is it- you're preserving your equity, you're getting cash flow, and you're getting tax benefit. There are very few things where you can get cash flow, tax benefit, and low risk to your principal, low to zero risk to your principal. And there's never zero, but low to minimal risk to your principal. I've taken people that are used to investing in the stock market and tried to describe these OZ deals or these net lease deals as like the bonds to their stock portfolio, right? Huge bonds have tax benefits, bonds have very low risk, and bonds have, a known coupon rate of return. That's what you're buying. But the difference is you buy a US Treasury, you're getting it at, let's say, 4%. Here, you're getting the credit of Starbucks or Caliber Collision or 7-Eleven or another CVS, another other companies that um, and you're getting it at 5% or maybe sometimes up to 6%. So that extra return. The other part is you've worked hard, you've made your money. Now it's time to enjoy your time. Like, you have essentially earned freedom of time. And what owning these assets gives you is freedom of time, because it's actually not the first of every month usually that the rent shows up. Justin, we've heard from most of our clients that it shows up a day or two before the first of the month. And and it's like, oh, well, the first is on a Monday, the last 2 days of the month are Friday, Saturday. I bet you most of our clients in rent got it on the Thursday or Friday before the first. And it's peace of mind. And it's, by the way, you asked with high net worth and other things, they're great assets to leave to your kids. There's some huge benefits in estate planning we can do, which talk about another time, but it's really something that, and with the OZ benefits, pass on to your state too, depending on your age. So,
Jason Brooks is with Buchalter. Jason, thank you for joining us today, talking about opportunity zones and how uh, investors can utilize opportunity zones after they've had an IPO, the benefits of an IPO event, and how it can be part of a strategy to defer, protect some, pay reduced taxes, and provide long-term passive cash flow. I'm Justin White, managing partner of Centennial Advisers. Thank you for joining us today.